I'm Larry Kudlow. Welcome back to Kudlow & Company. We aim to be right on America, right on business, and right on the money. And yes, we still believe that free market capitalism is the best path to prosperity. On this evening's program, Fed head Ben Bernanke held an interest rate cutting party in Washington, but nobody from the stock market really attended. Should make you wonder, Uncle Ben. Gold was up big, dollar down big. The Dow eked out a 9-point gain to close at 12,694. Tech, financials, and basic materials did rise. So did Asia, so did the emerging, so did China and Japan. Washington wants to bail out and spend even more of your money. The White House says no. Hillary looked soft last night. New home sales cratered. And Mr. Bill Buckley passed away. We'll get to that later in the program. We've got Fritz Meyer of AIM Investments. We have Joe Battipaglia of Stifel Nicholas. Jerry Bowyer, Chief Economist, Benchmark Financial Network, CNBC contributor. And Michael Ozanian, Forbes National Editor. Welcome, everybody. Thank you very much. It is a sad day for me, but the show must go on, literally. And Mike Ozanian, welcome back. Haven't seen you in a while. Mr. Bernanke held another interest rate cutting party, and really Wall Street decided not to show up. What's your take on that from an investor's standpoint?
I think investors are saying, hey, Fed Chairman, why do you keep moving us towards stagflation? Since the Fed's been cutting rates, since September, really? The market hasn't responded because I think what the Fed's missing, Larry, is we don't have a liquidity problem. We have a solvency problem, and interest rate cuts aren't going to help that. It's only going to fuel more inflation. Last year, consumer prices rose by 4.1%, the biggest increase in 17 years. Wholesale prices over the last 12 months through January were up over 5%. He doesn't get it.
That's a problem, isn't it? The inflation is a problem. The Fed could be in denial. I do want to contradict you on one issue. Since the really heavy lumber rate cuts, which occurred in January, the market is up 6%. You got to give it its due on that. But I want you to give me another talk before we get to the other guests. Give me another take on this business. CPI up, PPI up. We went through the numbers last night. I myself, now looking at the last 3 or 4 months, are saying, hey, you know what? This is an inflation problem. Why isn't the Fed dealing with this? You know, they say core inflation is not so bad, although it, too, is creeping up. But you know, it's funny, Mike. If you looked at the core economy, excluding housing, which is no sillier than excluding food and energy, that's doing well, so they don't need to cut rates on that basis. It's an odd, unbalanced paradigm.
It is, but, you know, Larry, you mentioned something. Food is something that hits every homeowner, you know, and that's a big problem, and I think we're starting to see that go up. And I think that's why it's a big concern. But you look at the commodities, you look at gold, wheat, copper, platinum, they're all rising substantially, and that signals inflation. You know, during the 60s and early 70s, when the Fed was pumping a lot of liquidity into the market, it took a number of years for inflation to kick in. And I'm afraid that that's what we're seeing now. And you mentioned at the top of the show a stimulus package. That's the wrong way to go. We shouldn't go more FDR. We need to be going more Ronald Reagan. We need to be focusing on tax cuts. We need to be doing things that's really fuel the animal entrepreneurial spirit of this country that leads to more investment and rewards more investment in businesses and companies and jobs.
Michael, I'm surprised at you. Don't you want to fuel the government bureaucratic spirit? I'm surprised at you on that.
I want to starve it. Even John Corzine in my home state of New Jersey seems to be finally getting the message with his latest budget.
Really?
So if he's getting it, why can't Washington get it?
All right, so Fritz Meyer, here we got you strapped in. I want to hear your optimism, but I'll say it again. Bernanke held an interest rate cutting party and nobody on Wall Street came. It's kind of getting old hat, maybe even a little boring. Or maybe stocks are beginning to think that's not the issue. There are other issues out there like flying commodity prices, energy, food, declining real wages, things of that sort. What's your take, Fritz? Bernanke kind of whiffed at the ball today.
Well, actually, I'm pretty optimistic based on the stock market. I think the stock market really hit bottom in January and is gradually working higher, and I expect it to be perhaps a good deal higher by year end. The Fed has consistently said that they're not too concerned about inflation, and the reason I think that's probably correct is, look, we've had a over 50% jump in crude oil just last year and a 5-fold increase over the last 6 years. I don't expect that rate of increase to continue. And the other aspect to the inflation story is, you know, the housing, the owner's equivalent rent is a big piece of that number. How do you square a deflation, a national housing deflation, with concerns over continued housing inflation. So I think probably they are correct in that. And at the same time, the guys who are saying pushing on a string, I just don't think that's accurate. I think the aggressive Fed stimulus that we've already seen will have an effect beginning quarter 2, quarter 3, quarter 4.
Why is the dollar plummeting then?
Well,
it's not just a function of housing. I disagree. Well, housing, you had a bubble there. But in terms of the dollar is plummeting, and that causes widespread inflation, not just in one asset area.
Well, wait a minute. The dollar is not plummeting. The dollar hit bottom, and it still hasn't retested that bottom on a trade-weighted basis. The most recent downtick against the euro really is based on the notion that the ECB probably won't cut rates anytime soon, and the Fed is probably going to go a little further. But that's not of a big concern,
well,
I don't think.
Fritz, I wouldn't really bet against the dollar hitting a new low here. I wouldn't go and bet the ranch on that. Your other investments are going to pay off better. Jerry Bowyer, at what point does the Fed become embarrassed and ashamed? Is it $1,000 gold? What point? Is it $125 oil? All these things seem to be moving together. I have not been all that worried about it until recently. In the last 3 or 4 months of these inflation indexes look lousy to me, the upward march in gold. At some point, you have to ask yourself, are these Fed policies causing a loss of confidence in the U.S. dollar, in U.S. investments? I mean, I really think that Bernanke's testimony today and Don Cohn, another Fed bigwig, his testimony yesterday was very one-sided. That's what I'm beginning to think. And frankly, I'm getting tired of it. I grew up under a president for whom I worked who said a great country needs a strong currency.
Right. You're asking at what point they become ashamed. And by the way, before I answer that, I just want to say my condolences on the passing of your friend Bill Buckley.
Thank you.
I know how much he meant to you. I think that the Fed, they always are ashamed of the last mistake, not the current mistake. The history of the Fed, overwhelmingly, they always do this. It's always too tight, then too loose, then too tight, then too loose. That's what central banks do. 99 too loose, 2000 too tight, 2003 too loose, 2006 too tight, 2008 too loose. This is the central problem of central banks. They always fight their last problem, and they don't seem sufficiently nimble to kind of respond. I've also been pretty sanguine about inflation. Really, 2 years ago we had a deflation problem. That was the great risk when the Fed was at 5.25. But each time they come down, the risk goes more from deflation to inflation. You know, they should have stopped at about 3.5. They didn't. They went down to 3. They should stop at 3. They won't. They'll probably go down to about 2.5. And at this point, I'd say we've moved more from a deflation risk to an inflation risk.
As I bring in Joe Battipaglia, we have a CPI chart. I'd like to put it on the full screen. We used it for Kudlow 101 last evening. Joe